So now that you have a policy, let's talk about why it needs to be an integrated credit policy, and we'll talk about what that means. If you have a good, coherent, comprehensive credit policy, it will provide ways for your senior management to really get a 360-degree view of your exposures. They're going to understand your portfolio. They're going to understand any concentrations you have in particular risk segments, high, medium, low. They're going to understand any concentrations as a percent of your total portfolio. They'll understand through reporting your current and past trends in accounts receivable, something that's very important to them to see if you're headed in a positive direction or if certain things need to be put in place to improve performance. It's going to help with risk assessment by tracking the customers and risk types in your portfolio, customers by channel of sale, sales territory, region, country, whatever. It's going to give some clarity to the level of risk to who you're selling to. It will provide opportunities for your company to sell to the highest margin and lowest risk. It will help your management understand where sales efforts are being devoted to lower margin and higher risk, and they may want to spend their time in a more fruitful way by aiming at customers that provide lower risk and higher profit. It optimizes your collection policies. It makes your staff much more efficient by having a good policy that drives efficient processes and procedures. So you can integrate the company's billing and pricing policies so that it minimizes disputes. It standardizes the terms of credit extension, which can have an impact on the total outstanding and your aging. Creates a customer-centric organization with a common face to the customer, so there's consistency in how you deal with customer-facing processes and procedures. It helps you correct errors quickly, so that if you have a policy that where there are procedures and processes on handling disputes and deductions that are efficient, you can catch errors and you can correct them, and you can minimize future errors of the same type. It helps with cross-functional communication, resolve root cause issues, because it will require certain workflows and reporting types and so on that improve your cross-functional communication. All this works towards doing everything right the first time, which minimizes your overhead expense, because it's costly to do reworks and issue endless credits for erroneous disputes, for example. It speeds up new customer approval and onboarding, and that has an effect on your shipments and operations. You have inventory that is built and waiting in a warehouse based on a sales forecast, and you're more efficient in approving credit. That improves the speed of your order-to-cash process and the ability for that product to get out of that warehouse and be invoiced and ultimately to be paid. It avoids order and delivery holds, shortens their life cycle by requiring certain processes that drive collections and staying on top of accounts and minimizing order holds. It establishes cross-functional metrics for all of these things. It brings accountability to all the processes that I've just covered, with reporting that adds transparency all the way up the line.